Is there a guy up there?
What?
Are there people in the booth?
There's nobody there. I'm just
okay.
looking at the clock. At 10:30 we'll start. Okay.
Morning. Good morning.
Could I have your attention, please?
All right, thank you. Hi. I'm Brian. I'm with the Private Equity Club, and just want to make a quick announcement about the Stern Private Equity Conference, which is happening on Friday, March 3rd. It's historically the largest conference that we have every year. We're expecting about 300 participants. And what makes it unique is the number of private equity professionals and venture capital professionals that will be in attendance. So if you've ever harbored illusions or dreams about working in private equity or venture capital, this is a great chance to come, sit and have lunch with them, and then in the afternoon we're going to have an open bar and cocktail hour and meet with some of these pros. The key right now is to sign up because there's a reduced cost, which is $55 for non-students if you sign up by this Wednesday the 15th. So you will want to go to this in 3 weeks. I suggest you sign up now, and it's going to be including breakfast, lunch, and cocktails. It's worth it for the food and beverage alone. So if you have any questions, we're going to be sitting in KMC over the next few days during lunch, and from 4:30 to 6, you can find out more there. Thanks.
So what happens to private equity that if the tax deduction for interest goes away? Think about it. 80% of all value created in private equity comes from the tax code. You take the tax code out, there you go. So there might be only 40 people at the private equity conference 3 weeks from now if the game plays out. But it's going to be a fascinating year because it's going to separate what really creates value from what's playing the tax code to create value. Right? So somebody should bring this up at the conference, and I'm sure it'll be a popular topic to discuss. So today I want to when we ended the session on Wednesday, I introduced at least the first step in risk and return models in finance. And I said in almost every risk and return model in finance, we defined risk as variance of actual returns around an expected return, And if you want to, you can go look up the variance of your stock or the standard deviation. It's one of the easiest numbers to find. Even if you don't have access to a Bloomberg or a FactSet, it's easy to find. So the last question I'd left you with is, do we live in a mean variance world? And the answer is no, but we still act like we do. It makes our life easier, so we're going to act like we live in a mean variance world. Let's keep building. We're going to make one unrealistic assumption on top of another to get to where we need to get, and then we'll say, okay, what now, right? So first step is we live in a mean variance world. Now I'm going to make a statement that's going to sound incredibly odd, but I'll try to back it up. When you invest in a stock, you're exposed to a lot of variance, a lot of standard deviation, a lot of uncertainty. You're not going to get rewarded for all of that uncertainty. And here's why. Not all uncertainty is created equal. And one of the suggestions I make is and try this out with your company. And I notice I didn't ask you how many of you are in a group, so I'm assuming that this is all behind us now. Think about your company and think about making a risk profile for your company. You know what a risk profile is? It's just taking everything you worry about with your company and just putting it down on paper. I'm worried about this. It's a cathartic to do it. Actually, put it down on paper. I'm worried about this. You're going to get a really long list, right? And then I want you to start putting the risk into buckets. You have no idea what I'm talking about, so let me take Disney as my example. As some of you know, the new Beauty and the Beast is coming out in a few weeks with Emma Watson playing Belle and I don't know who playing the Beast. It's going to be like a $150 million movie. Is it guaranteed to be a success? No, Cinderella was a success, but they're hoping it's going to be a success. But it could be the next Frozen, in which case it's an incredible success, $1.2 billion in revenues. Or it could be the next Lone Ranger. Remember that? When Johnny Depp played? I watch Johnny Depp, all I can see is a pirate. And I remember watching the Lone Ranger saying, why is a pirate on a horse? Right? But that movie crashed and burned. I think Disney wrote off like $180 million on that movie. So is there risk in the Beauty and the Beast? Absolutely. But if Beauty and the Beast fails at the movie theaters, it's only Disney that's going to be affected. It's not like the economy is going to come to a standstill. It's not like the entertainment sector is affected. It's risk that affects only Disney. You're saying, so what? Hang in there with me. Let's take one step up the ladder. How many of you have been to California Adventure? Okay. It's right across the walkway from the old Disneyland, the original Disneyland. And it was built because Disney wanted to attract older people to the park, people who'd spend, and it hasn't worked out the way Disney hoped it would. And we'll come back and talk about this. When California Adventure was built, Disney expected 60% of the people who went to Disneyland to cross over and come into California Adventure. That number's been closer to 40 or 45%. So for the last 10 years, Disney's been pouring money into that park. They've invested about $1.5 billion in the Cars ride, basically all those things added to the park. But at the same time, Universal is investing in its theme park in Southern California and in Florida in their Harry Potter ride. So basically, there's risk here, and it's risk coming from the fact that Disney is moving, the competition is moving. You have no idea how. This is risk that affects Disney, maybe Universal, and you could go down the list. Maybe 5 or 6 or 7 or 8 companies are affected by the risk. We've gone from risk that affects one company to risk that affects 7, 8, 9, maybe 10 companies. Disney's crown jewel is ESPN. We'll talk about why it is the crown jewel. It's a cash cow for Disney. It's a cash cow for a very simple reason. How many of you have cable? Okay, there's the first problem for Disney. If I'd asked this question, 5 years ago, 10 years ago, everybody's hand would have gone up. When you pay that cable bill every month, I hope you do. You're not pirating cable from your neighbor or something. Okay. When you pay that cable bill, do you know that $6 of that bill every month goes to ESPN? It is by far the largest single piece of your cable bill. The next highest is, I think, $1.20. Home Shopping Network is like 25 cents. $6 every month. This is ESPN, the cash cow. And for a decade, ESPN has carried Disney afloat because that's the cash that's allowing Disney to build the Shanghai theme park. But as you saw already, the problem that ESPN is facing is cable cutting. People no longer, my son, who's in his late 20s, doesn't have cable. He uses a combination of Hulu, Netflix. But the reason he's able to get away with it is he doesn't watch live sports. The only thing that stands between cable and the abyss is live sports. But that's shrinking, even that advantage is shrinking, because I'm a Major League Baseball fan. I don't need cable anymore because I have MLB.com. The only thing that pissed me off on is they're always 2 seconds behind whatever the play is. So I know the home run's already been hit, and then 2 seconds later a home run pops up. But maybe they'll fix that problem. But if cable increasingly comes under assault, ESPN and Disney are obviously going to be affected. If you think about the list of companies, there are probably 40 or 50 companies that live off the cable ecosystem, not just the cable companies, including some of the companies that provide the shows to cable that could not survive on their own. I'm not sure the History Channel could live on its own. I mean, if they said, pay $2 a month and you can watch the History Channel every month, I'm not sure how many people would sign up. So maybe if the cable ecosystem collapses, there might be 50 or 60 companies that might be affected. We've gone from risk that affects one company to risk that affects 10 companies to risk that affects 50 companies. Where does Disney see the most growth going forward in the next decade? Where are they putting the most money? Come on, this is the answer to any question to which you don't know the answer. China. It works really well. If you're ever asked a question you don't know the answer to, just say China. And let's face it, if you look at the largest companies around the world, China is a big part of their growth plans. You're saying, so what? Well, that's built on the presumption that China, which has had tremendous growth over the last decade, will continue to grow at 6, 7, 8% in real terms. But what if it grows at 2 or 3% in real terms? Is Disney going to be affected? Absolutely. That Shanghai theme park is going to be empty, but so are hundreds of other companies that have built their plans around around China. So we've gone from risk that affects one company to 10 companies to 50 companies, now potentially hundreds of companies. Now let's take one final step up the ladder. Have you ever seen Janet Yellen's testimony in front of Congress? Federal Reserve chairs always have to go in front of Congress, and it must be one of the most excruciating things you got to do as a Fed chair. They speak really slowly. Have you noticed this? Because every word they say, people are, oh my God, she paused just before she said that. Right? But let's assume at the next congressional hearing, she gets up and she says, the Fed sees signs of imminent inflation. And she doesn't have to finish the sentence, right? Because what's going to happen the next second? The bond markets are going to collapse. T-bond rates and interest rates are going to rise across the board. Is Disney going to be affected if interest rates go up? Absolutely, and so is every other investment in the market. We've gone from risk that affects one company to 10 companies to 50 companies to hundreds of companies to potentially every company in the market. You're saying, who cares? If I put all my money in Disney, I'm exposed to all these risks. You're absolutely right. If you put all your money in Disney, you're going to be affected to the risk on Beauty and the Beast just as much as you're going to be exposed to risk on what happens to interest rates. But you don't have to put all your money in Disney. If you decided to spread your bets, and I'm not asking you to go to the ultimate extreme of saying, I own an index fund. Just say you own 20 companies instead of one company. Think of why the risk that affects one or a few companies is going to start mattering less and less. First, there's an two thing. If only 5% of your money is in Disney, if Beauty and the Beast doesn't do as well as expected, you don't feel the pain as much, right? But remember, when we talk about risk that affects one or a few companies, it can cut in both directions. Maybe Beauty and the Beast will do much better than expected. Maybe it could do much worse. Remember the law of large numbers in statistics? Basically, when you have lots of, in this case, 20 or 25 companies in your portfolio, and there are things happening with individual companies that are truly firm-specific, things are going to start averaging out. In fact, if you want to see this practically on a personal level, if you have a portfolio of stocks, we're now in earnings season, right? Every day another big company reports earnings reports. just now, as you look at your portfolio through those 2 or 3 weeks of the earnings season, you're going to get your own highs and lows as you track, right? Some of the companies you invest in, you're going to see them come in with better than expected earnings, and you're going to see the stock price go up. So if you happen to own Apple when it came out with its earnings report, you saw the price jump. But if you also happen to own Amazon, when its earnings report came out, it dropped 4%. Across a portfolio, those risks are going to average out. This isn't rocket science. We don't need statistical proof. I know in foundations you went through the proof of you use correlations and covariance. You don't need them. It's just a law of large numbers, and as you diversify, what's going to happen is the risks that affect one or a few firms is going to start disappearing in your portfolio. And in fact, as you get more diversified, the only risks that you'll be left with are the risks that affect most or all firms, which are going to be more macroeconomic risks than microeconomic risk. It's actually one of the toughest concepts in finance to grapple with, right? Because if I came to you with a company with bad management, your immediate response is that's a risky company. Not necessarily. Let me give you two contrasts. Let's assume you have a company with bad and guaranteed bad management, and another company with really good but uncertain good management. The guaranteed bad management company is actually very safe. You're always going to make a crappy return on your projects. They're going to do really stupid things. You price it into the stock. It's no longer risky. We have to separate out good companies from good investments. From thinking about risk as connected to how a company is run and thinking about it in terms of uncertainty about how the company will be run. So that is, I think, the key step in the CAPM is accepting this rationale. And a lot of people fight this. They never are able to get over this hump of, hey, I'm investing in a stock. Why shouldn't I get rewarded for all of the risk I take on? And the answer is because much of that risk is avoidable if you've done something very simple, which is spread your bets. Nobody's ever forced to put their money into a single company as an investor. And if you choose to do it, accept that this is on you, not on the market to reward you for doing something you didn't have to do. Now I'm going to introduce a concept that's going to drive the way we think about risk. The reality is, most people in this room are not going to be diversified right now. Why? Because of the stage of life you're at. You're not accumulating savings. If you buy a stock, you don't have the advantage of having 50 stocks. You don't get there right away. Of course, you could put your money in an index fund or a mutual fund and get there. But if you try to build your own portfolio, it's going to take a while. And many investors, in spite of the opportunity to diversify, choose not to diversify. The median number of stocks in an investor's portfolio in the US is? And this is among the active investors, because there's a whole group of investors who buy index funds, ETFs, etc. But there are investors who go buy individual stocks. You know what the median number is? 3 to 5. You can lecture them till you're blue in the face that you shouldn't do it, but the reality is most investors don't diversify. So I'm going to introduce a concept that's going to drive the way we think about risk. It's called a marginal investor. You're saying, who the heck is a marginal investor? The marginal investor in your company is the investor who's setting prices at the margin, who's driving that pricing process. I'm not a marginal investor in Apple. I'm an Apple stockholder. I'm not a marginal investor. You know why? Because I have only 1,000 shares, or 3,000 shares, or 5,000 shares. To be a marginal investor, to affect prices, you have to have lots of shares. And to affect prices, you have to trade those shares. We've introduced two requirements that's going to make it easy for us to identify who that marginal investor is. Marginal investor is somebody who owns a lot of stock and trades that stock. One condition alone won't do it. So in the case of Oracle, the largest investor in Oracle is Larry Ellison, owns 26% of the stock. He's not the marginal investor in Oracle because he doesn't trade that stock, because as a founder CEO, if he started trading the stock, he'd have to give up control. So his shareholding has remained pretty much intact for the last 10 years. He's not the marginal investor in Oracle. So who's the marginal investor in Oracle? It's got to be another large investor who trades So I'm going to go down the list. Remember that HDS page I showed you, the top 17 investors? If you print that off for Oracle, at the top of the list you'll see Larry Ellison. I'm going to look and say, he's not the marginal investor, he doesn't trade. You know who's next on the list? It's BlackRock. I think BlackRock owns the world. There's a conspiracy going on. One of these days we're going to wake up and find BlackRock. But it's amazing. You see the same names, BlackRock, State Street, Fidelity. And does BlackRock have a diversified portfolio? Yeah. And that's, I think, the key to understanding why, in the case of publicly traded companies, the marginal investor is likely to be a diversified investor. And you're saying, why do we care? Because when you look at risk in a company, and this is you and I, even though we might not be diversified, we have to think about risk not through our eyes, because we could see a lot of risk, but through the eyes of those marginal investors. It's actually a tough thing for managers to do because they want to think about the entire company. They want to think about all the risk, and you have to tell them, look, you can worry about all the risk you want, but your investors, those investors who are setting your stock prices, are thinking only about the portion of the risk that they cannot diversify away. That's the risk you should be bringing into hurdle rates to make sure you earn a higher rate of return. So it's those two key steps that get us to accepting the fact that when you invest in a company, when you think about risk to bring into a hurdle rate, the risk you should be factoring in should only be the risk that you cannot diversify away. It's not about you and I being diversified, it's about the marginal investors in the company being diversified. And as long as that condition is met, you're okay. So here's one of the things I do when I'd suggest you do this for your company as well. A lot of free services, Yahoo Finance has it, Google Finance has it, S&P Capital IQ definitely has it. You can look up the percentage of shares in your company that are held by institutions and the percentage of shares in your company held by insiders. It's almost public information for pretty much every US company and increasingly for global companies. So percentage by institutions, percent. The insider definition that S&P Capital IQ uses is the same insider definition that the SEC uses, which is managers, directors, founders, etc. Look up those two numbers. If you find that the percentage of stock held in your company by institutions is 70, 75, 80%, and insiders own almost nothing in your company, you can rest assured that the marginal investor in this company is a large institutional investor. So I'll give you an example. You print this off for, pretty much for Procter & Gamble. Okay? You look down the list, you're not going to find a single individual on the list, and I think 83% of the shares in Procter & Gamble are held by institutional investors. So that's a no-brainer. Marginal investor is an institutional investor. You could print off the list for Oracle, and you're going to find that institutions own 63% of Oracle, but you do have an insider, Larry Ellison, so you have high insider and high institutions. But I'm going to argue that even in that case, it's the institutional investor who's the marginal investor. Because for Larry Ellison to feel wealthy, what has to happen? They have to like your stock. It's very strange because you're saying, I'm the largest investor, why can't I do what I want? He could, but in the process, he could knock off 30% of his wealth, and that might not be worth the trouble. So there, the marginal investor is still going to be an institutional investor, but once in a while, what's good for the insider is going to kick in and override what's good for the institution. So maybe Larry Ellison wants an island in Hawaii. He seems to like Hawaiian Islands. Now, he owns one of them, actually. He wants a second island. He wants to buy Maui. And he says, let's do an acquisition of Maui. Oracle buys Maui. I don't think it can be done, so don't worry. If you're from Maui, you're safe. Okay? But once in a while, you might have the insider or the America Cup, right? Because that's another Larry Ellison pet project. He wants to win the America Cup. Oracle is a big sponsor of the Cup. Maybe that's the insider thing kicking in. But he has to be careful. He still has to keep the institutional investors happy. You could have a company where the institutional investor holding is low, and the insider holding is high, and the insider holding is held by a founder manager of the company, especially in the early stages of young companies just after they go public. And I'm not talking about the big young companies like Facebook, and I'm talking about the really small ones that are under the radar. Right after they go public, you might find the insider owning 40, 45% of the shares. Institutions weren't really interested in this IPO because it was a really small one. You could end up with individuals holding it. There you have a troublesome scenario. This company is more like a private company than a public company. because it's going to be run by the founder as an extension of a private company, because the marginal investor might be other individuals who got this company as one of their 3 stocks. In fact, there are some markets where if you look at the public marketplace, you see thousands of listed companies. You'll be impressed. I mean, take the Indian market. It's got 4,000 listed stocks. 3,200 of them have no business being listed. They're really a private company where the owner lists 2% of the shares. I'm not kidding, 2 or 3% of the shares. Why? Curiosity. I just want to see what the price would be. These are private businesses. They'll be run like private businesses. We'll come back and talk about what to do with these companies, because those owners are not thinking only about the macro risk. They're thinking about all risk. They're thinking about risk like a private business owner thinks about risk, which is to think about all risk. That's going to not fit traditional risk and return models. We have to talk about how to adapt the models. You could have percent of stock held by institutions be low. High insider holding, but the insiders are not founder CEOs, but wealthy individuals. Paul Allen, for instance. You know who Paul Allen is? He co-founded Microsoft with Bill Gates, and then early in the process, he kind of spun off on his own with a lot of money. And he's invested in a lot of public companies. He owned the Portland Trail Blazers. If he is your individual holding, the wealthy individual who owns shares in your company, he's in a sense a diversified investor on his own, because he has lots of holdings in his portfolio. So you could argue that if that wealthy individual investor is diversified, you're okay with, see, basically the question I'm asking is, are we okay using traditional risk and return models in finance? And for that question to be answered in the affirmative, you have to convince me that the marginal investor is diversified. Because if you don't, then I've got to modify the models. And finally, if you have low institutional holding and low insider holding, you're a company held primarily by individuals, which is often true for many emerging market, mid-cap and small-cap companies, then you could end up with individuals being the marginal investors, and all bets are off. Because as we said, individual investors often behave in strange ways in terms of how much they hold in their portfolio. You could be violating a basic building block of the model. So when you think about the CAPM, the arbitrage pricing model, the multi-factor model, all of those models are built on the presumption that the marginal investor is diversified. And if that assumption breaks down, you're going to be in big trouble. So let me go back and check with my companies to see if I'm okay using the CAPM arbitrage, any of these models. So I took a look at Disney. I showed you Disney in 2003, right, where there was only one individual on the list, and it was Roy Disney, and he owned 0.67%. I showed you Disney in 2009, and at the top you saw Steve Jobs. This is Disney in 2013. Now, that's Lorraine Jobs, Steve Jobs' widow. She is now, in fact, that holding is almost exactly the holding that you saw in 2009 for Steve Jobs. It's a little higher because Disney actually bought back shares between 2009 and 13, which increased the percentage. Notice who else is on this list who wasn't there? George Lucas. How did he get there? Well, this was Lucasfilms, which Disney, one of the great we'll talk about this later, one of the great bargains of all time for Disney, because Disney got Lucasfilms for $4 billion. It's a Star Wars franchise. And later in the class, I'll actually value the Star Wars franchise 6-7 years later, and you can decide whether they got a bargain or not. But basically, when you look at this list, you do see some large individual stockholders like George Lucas and Lorraine Jobs. I don't think they're going to be marginal investors. Neither wants to get rid of the stock. They're not going to be sitting there if they're going to get out, they're going to get out. They're not going to be trading the stock. So my guess is it's got to be one of the remaining people on this list. And if you go down that list, you're going to see one institutional investor after another. So with Disney, I feel I'm on safe ground, assuming that the marginal investor is a diversified investor. Okay? And that's probably going to be true for any of the S&P 500 companies. I can't think of a single S&P 500 companies where I'm lying awake at night saying maybe the marginal investor is not a diversified investor, because on every single one of them as you pass through the test. And in fact, I'll extend this. I would argue that this is going to be true for almost every large market cap company in whichever market you're looking at. So you go to Indonesia, you look at Indofoods, big Indonesian food company. You look at the top 15 investors, guess who's on top of the list? BlackRock. I told you they're everywhere. Okay? It's amazing. It's kind of scary. You print off in the most obscure markets in the world. You take the 10 largest market cap companies, you print off the top 17, that HDS and Bloomberg will do it for you. BlackRock. Okay? We assume that somehow if you go into emerging markets that companies are not held by institutions, let it go, because increasingly not only is your marginal investor an institutional investor, but it's a global institutional investor, not even a domestic institutional investor. So I decided to extend this to my other companies to see if I was on safe ground. With each company, I looked at the percentage held by institutions and individuals, and the reason the Disney individual number is so high again is because of the jobs. In fact, the rest is probably managerial options granted over time. With Deutsche, the inside is 7.5%, but that probably doesn't even include the George Lucas holding fully. Eh? With individual is 21%, institution 70%. Basically, with Disney, institutional investors are the marginal investors. Deutsche, you have a lot more individual investors. Many of them happen to be German domestic investors. No? But the institutions account for 80% of the trading. That's actually another number you can check. Not only what percentage of the shares are held by institutions, what percentage of the trading. Because remember, you need both legs to kick in. So even though only 41% of Deutsche is held by institutions, 80% of the trading comes from institutions. And the same is true for Tata Motors. The reason the insider holding is so high at Tata Motors is we're counting those cross holdings from Tata Steel and Tata Chemicals. Those holdings never get traded, because if they get traded, the Tata Group loses control. So with every one of these companies, as I went company to company, even in companies where the institutional holding was small, when I looked at the trading volume, I felt okay at the end of the process saying with each of these companies, I'm okay assuming the marginal investor is diversified. And the extension of that is, the only risk I'm going to price in then is the risk that I cannot diversify away. So that's why we do this. It's not because it's an abstraction, but to make sure that we're okay making that assumption, because that's a big assumption. The assumption that all that risk that is firm-specific or even sector-specific then can get diversified away. Any questions on this diversification question? Yes, go ahead. Yeah. But remember, they sell and they can buy again. It's not they buy and sell and move on, right? So if you're BlackRock, you buy shares, you sell those shares. You're not out of the game. You could buy shares again, sell the shares again. So when we talk about influencing the price, this isn't a one-time game. This is a game where over time, and it's not even a specific name you're thinking about. You're thinking about collectively who's driving prices. So don't even put a name, BlackRock, State Street. Think about collectively today. If you look at what happens to Disney's stock price, what's causing that price to move is primarily institutional trading. That's all we care about, because once you make that judgment, then the rest kind of follows. So it's not even that we're pinning a particular institution as a marginal investor. We're saying the typical the marginal investor is an institutional investor. It could be BlackRock today, it could be State Street tomorrow, it could be Fidelity the day after. And as long as that is true, whatever their motivations, it's their perception of risk that's driving the pricing, and that's what I should be building on, because I piggyback on them. Much as I might want prices to move differently, I'm affected by how they affect prices. Yeah. Any other questions? So now let me bring this back to the CAPM. The argument that diversification is a good thing to do, the prudent thing to do, is as old as time. All the old proverbs, don't put all your eggs in one basket. That's a diversification proverb. Okay? So what does a CAPM do that's different? Let me make this about me. I have 53 stocks in my portfolio, but I have only 53 stocks. You say, what do you mean only 53 stocks? If diversification is good, the question I'm asking is, why do we stop? Because you can actually statistically show that as you keep adding investments, your firm-specific risk is going to get smaller and smaller and smaller. It's true the marginal benefit will get smaller as you add extra stocks. The first stock you add will create the most benefits, and then as you keep going, the 51st stock, but it will always be positive. So the question is, why did I stop at 53? Give me the answer. There's one very cruel answer you can give, and then we can move on to the other answers. What's a cruel? I don't have enough money. True. Okay, we got that out of the way, but then why does Fidelity Magellan stop at 150? They have $120 billion to invest. can't be that they don't have enough money, so why did they stop? I heard somebody say transaction. One is there is a cost, which is it's not free. It's not just transactions cost, it's monitoring cost. I mean, adding a, so, but let's face it, that's what, $9.95, $8.95, and for Fidelity it's probably $5 a trade. So that cost has come down. If it were just transactions costs, we wouldn't be stopping as soon as we did. So what's the other reason we stopped? I'm sorry? Well, you're 99% of the way. Why not go 99.5% of the way? Why not 99.9% of the way, right? I agree with you. The marginal benefits decrease. Does anybody in this room want to be an average investor? How much mileage do you get at a cocktail party if you say, I'm an average investor? People don't exactly gather around you for anecdotes, right? Let's face it, we all want to beat the market. Even those people who claim to be efficient marketers secretly want to beat the market. And whether it's true or not, we think we can pick the right stocks. Implicitly, when I say I have 53 stocks, what have I told you? I think I've got the 53 best stocks in the market, which might be completely false. But my delusion is my delusion. I can keep going with that delusion. So the two reasons we stop are transactions costs and what I'm euphemistically going to call private information, that you know something that the rest of the world doesn't, and you're picking the best stocks. You know what the first two assumptions of the CAPM are? No transactions costs, that collectively includes all costs, and no private information. So let's bring those assumptions in. In a world with no transactions costs and where you don't know which stocks are good and which stocks are bad, when should you stop diversifying? The answer is never. You wouldn't stop at 53, you wouldn't stop at 500, you wouldn't stop at 2,000, you wouldn't stop at 7,700, which is all US stocks. You wouldn't stop at 41,668, which is all global stocks. You'd buy every traded bond, every piece of traded real estate, and you're going to end up with a portfolio with a little piece of every single traded asset in the marketplace. You're saying, that is absurd. But we made two absurd assumptions to begin with. Of course the conclusion is going to be absurd. Hang in there with me. You have a small piece of every single traded asset in the market in your portfolio. What should we call this portfolio? Oh, let's be creative and call it the market portfolio. And in this world, you can see that's where we're all going to end up. Think of it as a gigantic index fund. We're actually not that far away from creating this gigantic market portfolio. A gigantic index fund that invests in a little piece of every single traded asset held in proportion to its market value. And here's what each of us does. We pick up the phone, if we're old-fashioned, or we get online, and we buy that index fund. That's the only thing we'll all buy, because it is the most efficient way to invest in a world with no transactions costs and no private information. But here's the puzzle then. How do we reflect the fact that we're all not equally risk-averse? That some of us, if you're all buying the same index fund, you're saying, how do I take more risk than my neighbor? So let's make this real. How risk-averse are you? Very risk-averse? Not at all. Okay. I'll make you the risk-taker. Are you risk-averse? Okay. So he's risk-averse. Is there somebody who absolutely is terrified of risk? Come on, somebody put up their hand. You can be completely terrified of risk, okay? Even though you're not. So if you view that as an insult, switch roles later. Okay? So I come to you and say, look, there are only two places you can invest. You can invest in this gigantic index fund, which has every single risky traded asset, or something riskless. You want to take no risk at all, what are you going to do? You're going to put all your money in the riskless asset. I'm going to say, okay. I come to you and say, okay, you know how much, and you're willing to take some risk, so you say, I'll put half my money in that index fund with risky asset, the market portfolio, and half of it in the riskless. So I've taken care of your risk by allowing you to alter the proportion you put into them. Now I come to you and you say, okay, I'll put all my money. Let's say she wants to take even more risk. She looks like a risk taker, a massive risk taker. In this world, how is she going to take risk? Because once you hit 100%, if you're still not satisfied with the risk you take, you want to take even more. In this world, what's the most efficient way for you to take risk? Go borrow money and do what? Buy the same index fund. So the way in this world that we reflect our risk aversion is the proportions we put into what's riskless and what that index fund holds. The reason, the intuition is very simple. You're saying, why shouldn't I just buy the riskiest stocks in the market? Because it's not an efficient way to take risk. Because you expose yourself then to that sector risk. It might be all tech companies. This way you take all the risk you want to take, and what you alter is how much money you put into the riskless asset, and that can be 100%, it can be 0%, it can be minus 100%. You say, what does that mean? When you borrow money to invest in the index fund, that's basically what you're doing, is you're putting the weight on the riskless asset at below zero. We're in the CAPM world. Let's say this is the entire marketplace. We've all bought into the assumptions. We believe in mean variance. We assume marginal investor is diversified. There are no transactions costs and no private information. We've all ended at the steady state. All we have is one index fund and one riskless asset. Now I come to you with an individual asset. Give it a name. Snap. Remember, I'm trying to sell you Snap, and you're asking, how risky is Snap? Remember, you got the bulk of your wealth already invested in this market portfolio, which includes every single risky asset in the market, right? So when you think about risk of an additional investment, you think of it in terms of the risk it will add to your portfolio. Not by itself, because by itself you don't care. You're saying, how much risk will Snap add to what I already own? And since all of us own that same risky index fund, we're going to measure risk relative to that fund. That's it. You got the CAPM, because once you got there, then it becomes a question of how do I come up with a measure for that risk. The next time you use the word beta, I want you to remember all this baggage I've dragged along so far. Because when you measure the beta for a stock, what are you measuring? You're measuring how it moves with that market portfolio. Beta doesn't measure the risk in a stock. That's a misnomer. Beta doesn't measure volatility. It's got nothing to do with it. Beta measures risk added to a diversified portfolio. And the reason we're able to get away with that is by assuming the marginal investor is diversified and therefore doesn't care about all that firm-specific risk. What beta measures is how your stock moves with the market portfolio. And here's why it matters. If Snap has returns and profits that have nothing to do with the rest of the world, it just moves on its own. Some periods it does well, badly. It could be a risky stock standing alone, but added to your portfolio, it could add no risk because it's completely uncorrelated with the market. If Snap moves a lot with the economy and the market, it could have a high beta. Is it possible that Snap could actually reduce the risk of your portfolio? For that to happen, what's got to be true? It's got to move in the opposite direction. So when the market does well, if Snap goes down, you could actually reduce the risk of your portfolio by investing in Snap, in which case your beta could be negative. So there's a classic interview question. Can betas be negative? The answer is yes, if it's an investment that reduces the risk of your portfolio. We'll come back and talk about the economics of what kinds of stocks might have that. But that's, I think, the key step in this process. Because once you come up with me all the way up to that line and said, okay, I agree with you, beta measures the risk of a stock as a risk added to a portfolio, then I can give you the expected. Remember, this is all about hurdle rate. I can now tell you what return you need to make on an investment as the risk-free rate, the base from which I'm going to build off, plus the beta for your investment, times the risk premium for an average risk investment. That's what that number in the brackets is. We'll come back and talk about the mechanics of how do we come up with risk-free rates, how do we come up with risk premiums, and how do we come up with betas. For the moment, though, I want you to savor that equation, if that's the right word. Okay? Because that's the end result of all of these assumptions we piled on to get there. Any questions on the CAPM? So I didn't use any covariances, correlations. If you really are attached to those equations, go take a look at them if you want. Because the intuition for the CAPM doesn't require that you ever use a statistical term. It's all based on sheer logic if you're willing to go along with the assumptions that get made along the way. I'll make a confession. I still use the CAPM in valuation. I still use the CAPM in corporate finance. And the first thing that happens whenever I do a valuation is people won't even take issue with my margin. I can make all kinds of crazy assumptions about revenue growth. I can make you larger than the universe. They're not even looking at it. They get fixated on the beta. How come you're still using the CAPM? And the less they know, the more dangerous they become. There are 3 levels at which I get critiqued for using the CAPM. And I'm going to give you all 3 because if you ever have to use the CAPM in any of your analysis, be ready for these 3. The first critique I hear is the model makes unrealistic assumptions. Does it? Absolutely. No transactions cost, no private information. But you know what? I'm absolutely okay with it because in a previous lifetime, I used to be an econ major for a very brief period in my lifetime. And I still remember those realistic models in econ that nobody can use. Remember that model that has a second derivative of the utility function to wealth? I remember putting up my hand saying, how do we get to measure this? I remember the instructor saying, nobody's seen it yet, but once you see it, it's all going to be clear. If you're giving me a choice between a model that makes unrealistic assumptions that I can use and a model that makes realistic assumptions that nobody can use, I'll pick the former over the latter. We live in a complex world. Any model that's tractable and usable will have to make unrealistic assumptions to get there. And as long as you're aware of what they are, maybe you can adjust for it. The second critique that I hear, and this is usually from the coward in the back row, he puts up his hand and says, but you could be wrong. About what? Your beta could be wrong. To which my response is, that's all you think I got wrong? You should see my revenue growth, my margins, my cash flows. They're all wrong. You know why they're wrong? Because I'm trying to play God and forecast the future. I am guaranteed to be wrong. If your test for a model is, I will use a model only if you guarantee that every input is right, you're never going to use a model in this world. So that critique is easy to swat away. And then comes the critique that cuts to the bone. Remember that 5th requirement for a good risk and return model that I added very grudgingly to the list? I know you don't. So I'll tell you what it was. The model has to work. Remember that unpleasant requirement? So the third critique is the one that cuts to the bone. If the CAPM is the right model for risk, all of the risk is captured in a beta, right? That's the only thing that matters. So if I take a very long time period of stock returns and I look at return variances across stocks, why some stocks make high returns and others make low returns, 100% of that variation across long periods has to be explained by betas. If the CAPM is right, and I took 25 years of data, 100% of the variation in returns across stocks has to be explained by betas. You know what the actual percentage is? It's 8%. It's a kind way of saying we're using a model that doesn't explain 92% of what's going on. That's a scary place to be, right? Now you're trapped. You're saying, what the hell do I do now? I'll give you an anecdote. Why? Because by the time you finish the anecdote, they'd have forgotten the question, you can move on. So feel free to use this anecdote about why it's still okay. It's about these 2 guys who go camping up in the woods somewhere. It's late at night, campfire's dying out, mellow time. Chatting, and you hear the sound of a crazed grizzly coming at them through the forest. It's killing everything in its path. They can hear other animals screeching, other campers squealing. So one of the campers gets up into a sleeping bag, zips up and gets ready to die. I don't know what form this takes, but no, I'm sorry for all the bad deals I did. No, forgive me for this. No. The other guy starts warming up in place. So the guy in the sleeping bag says, what are you doing? You can't outrun a grizzly. They're in 50, 60 miles an hour when they're crazed. The guy in the sleeping bag says, look, I don't have to outrun the grizzly. All I have to do is outrun you. It's a morbid thought, but kind of hang on to it. I think often when you defend models like the CAPM, you feel this urge of 8% is not. But remember what Milton Friedman said, it takes a model to beat a model. The CAPM is a really crappy model until you start looking at the other models. They're all equally crappy. Let me ask you a question. If you had a choice between using a crappy model where you have to estimate only 1 parameter and a crappy model where you have to estimate 5 parameters, which one would you take? I'll take the 1 parameter. Why would I go to all this work if I'm going to get an equally crappy outcome? My defense of the CAPM is not that it's perfect, but it doesn't matter as much as you think it does. It explains just enough that I'm okay with it. Because I know what many managers who want to put me on the spot by doing this want me to do instead. Instead of using the CAPM, you know what they want to use instead? Gut feeling. You know what the R squared between gut feeling and returns is? It's well below 8%. So they basically want to do whatever they want. They want to stick their finger, hold in the air, and say, I'll use 12%. No, I'm not going to let you go there. If you want to abandon the CAPM, give me something concrete you're going to use instead. In my valuation class, I offer 12 different alternatives, ranging from accounting ways of measuring risk to just qualitative ways based on sectors of measuring risk. I'm okay with any of these if you don't like the CAPM, but you need something to beat the CAPM because you can't just say it's a bad model, therefore I'm not going to use it. So the CAPM persists partly because of the competition. You have all these other models out there, they all have issues. So let me go through the competition for the CAPM. In fact, this is my attempt at taking everything I know about risk and return in finance and putting it on one page. And guess what? It wasn't that difficult. So let's start by looking at the first two assumptions because we've already gone through them. Every single risk and return model in finance makes the assumption that variance measures risk. It also makes the assumption that the marginal investor is diversified and therefore the only risk you should be measuring is risk you cannot diversify with. So those first two steps are just like the CAPM. The CAPM, of course, was the first of the models out of the gate. 1964, Bill Sharp and John Lintner come out of the model. They won the Nobel Prize for it 30 years later. For about 15 years, the CAPM was the only game in town. It was a CAPM or nothing, and obviously the CAPM won. Until 1977, when a professor at Yale called Steve Ross said, hey, why are we trying to measure all of this macroeconomic risk exposure a company has with one beta? Why don't we allow for multiple sources of macroeconomic risk and have a beta against each one? Sounds reasonable, right? But when he came out, the pushback was, hey, but how will we ever know how many different sources of market risk there are, and how will we ever come up with betas against each one? He said, not a problem. Give me a really powerful computer and stock returns for the past 50 years, daily. So he plugged all this data in, huge amount of data, and he sent the computer on a search mission. Searching for what? Remember the definition of macro market risk is risk that affects most or all companies at the same time. That's what he said asked the computer to do. Look for times when lots of stocks seem to move in the same direction, either go up or go down. And look to see which kinds of stocks are most exposed to these movements. It's called a factor analysis. It's a statistical approach. So what the computer is looking for are factors, common factors that are causing stocks to move. And the output from a factor analysis is actually very interesting. It tells you the number of factors it found by looking at stocks. So when Ross first ran it, the computer came back and said, we found 5 factors. 5 macroeconomic factors that seem to affect stocks for the last 50 years. And here's the bonus. It gives you a beta for each stock against each of the factors. So it says, for Pepsi, the beta against factors, so it basically lists out the 5 factors and the betas. That's called the arbitrage pricing model. It breaks down macroeconomic or market risk into multiple factors and comes up with the beta against each one. When that model came out in 1977, people thought that this was the godsend. Now we could put the CAPM aside, replace the arbitrage pricing model. But it never quite caught on. And to think of why, I'd like to put you in the shoes of an investment banker trying to use this model. So this is 1979. You work at Solomon. Solomon was one of the first investment banks to jump on the bandwagon and use the arbitrage pricing model. I'm going to be your client, Pepsi. So you show up in my office and saying, hey, I have a new way of computing your hurdle rate. Instead of that old CAPM we've been using, we have this arbitrage pricing model. We plug the numbers in for your company, my company, it's Pepsi, and come up with 21%. This is 1979. Rates were much higher, but I was used to using 16% with the CAPM. Now you're telling me it's 21%. So I ask you what I think is a very legitimate follow-up question. Why is it so high? And you tell me. Tell me it's because I'm very sensitive to the second factor. You know what the next question coming at you is going to be, right? What the heck is the second factor? And you say, I don't know, but be very careful when it's around. And therein lies the weakness of the arbitrage pricing model. It's a statistical model. So when the output comes out, there are 5 factors, and guess what they're called? Factor 1, factor 2, factor 3, factor 4, and factor 5. There is 0 chance that any client of yours is going to use a hurdle rate because you tell them they're really sensitive to factor 2, but you don't know what factor 2 is. So back to work. As you walk back forlorn to your office, you think about why your pitch failed. Why did it fail? Because when you were asked what factor 2 was, you couldn't come up with a name, right? Therein lies a solution. If you could just attach a macroeconomic name to each factor, you could get people to use it. You could arbitrarily name the factors, but that wouldn't be fair. So here's what both investment banks and academia did. Basically, they got research teams going, looking to see whether they could fit macroeconomic names to the factors. It's actually easier than it sounds. Because when you do factor analysis, you actually get a graph of factor 1 over time, a graph of factor 2 over time. What they tried was if you put two transparencies on top of each other, so that looks a lot like term structure. That looks a lot like the level of rates. That looks like the default spread. And 4 years and several $1 million later, you'd attach macroeconomic names to each of the 5 factors. You got a new model. It's called the multi-factor model. Basically, once you put names on the unnamed factors, you've gone from an arbitrage pricing model to a multi-factor model. Again, you think you've solved the problem. You come back to Pepsi, ready with this new model, multi-factor model. You tell me that my hurdle rate is 20%, still high, so I ask you why it's so high. And this is because you're very sensitive to the second factor. And this time you're ready for the question. In fact, if I don't ask the question, you'll ask it yourself. So what's the second factor? You tell me oil prices. I say, what? We don't use any oil in Pepsi. It might taste like we do, but what the heck is it? You see what happened? How did those... Basically, it's statistics and math PhDs who were fitting the factors. They were looking backwards. And the decade leading into the 1980s was the 1970s, obviously, which was a period where oil prices were a big factor driving stock prices. They did their job of fitting the factors to what had happened in the past. The only problem is by the time you got to 1983, oil prices were no longer driving stock price. You'd fit a great model looking backwards, but not a very good model going forward. Multi-factor models, that's always been the weakest link. They are great at explaining past returns, almost by definition, right? Because you're trying different factors to see which ones work. But they're not very good at explaining future returns. And the final leg in this discussion happened in the early 90s. Two professors at the University of Chicago, Ken French and Gene Farmer, said, you know, why are we even trying to come up with a risk and return model? Why don't we let the market tell us what's risky and what's safe? He said, how will the market tell you? They said, let's look to see what kinds of companies have earned high returns in the past and what kinds of companies have earned low returns in the past. So they looked at 1962 through 90 data, and they found that over that period, small market cap companies earned much higher returns in the marketplace than large market cap companies. And they made a leap of faith. They said, if small market cap companies earn higher returns in the marketplace than large market cap companies, it must be because they're riskier. You see why that's a leap of faith? You're assuming that over long periods, if stocks earn high returns, it must be because the market thought they were riskier. It says market cap is a proxy for risk. They found that low price to book ratio companies earn higher returns than high price to book ratio companies. Price is the market value, book is the accounting value. They said that must mean low price to book stocks are riskier than high price to book stocks. These are called proxy models for risk. You see why I call them proxy models? Basically, you've given up on measuring risk, you're letting something else stand in. The market cap of the company, the price to book ratio of the company. It takes a form of a regression equation where if you give me your market cap as a company and your price to book, I'll plug it into the equation and say your hurdle rate is 7%. Why? Because you have a big market cap and a high price to book ratio. So Facebook will end up with a really low hurdle rate, big market cap, high price to book ratio. If in contrast you're a small market cap company with a low price to book, I'll say your hurdle rate is 18% because that's what the market's historically paid. Basically, you've thrown up your hands on measuring risk, you've let these proxies come in. And every risk and return model in finance today is one of these four or a combination of the four. The CAPM stands still as a default model. You go into every investment bank, you look at S&P Capital IQ, you look at FactSet, you still see a beta. And you still see people using betas. And the reason, as I said, is very simple. It's because the multi-factor model, the arbitrage pricing model, the proxy models do better at explaining the past. So if your job is performance evaluation and portfolio management, those models have taken hold. But if your job is corporate finance evaluation, where your job is going forward, the CAPM kind of hangs in there simply because it does at least as well as the next best model and often better especially if you do a good job of estimating those betas and risk premiums. And that's what we're going to spend some time on, is how, given the constraints of the CAPM, can we come up with better estimates of the beta and the equity risk premium, accepting the fact that there's going to be noise, which is going to cause our estimate to be sometimes off from what the actual hurdle rate should be. Any questions? Yes?
Are there any other models, like those ones by this French professor, Yale, I think, or Harvard?
What does he do? Every model you see out there will be some variant. So, for instance, I can have different proxies, right? I can sort of market cap and price to book. There are people who use earnings momentum and price momentum and number of analysts. So whatever model it is, it's falling into one of these buckets. It's a variant of a basic model, and it has all the weaknesses that those models have had historically. So when you think about risk and return models, there's really not much to go beyond these 4 buckets. But within these 4 buckets, your variants, different ways in which this model can be applied. So I'll wager, if you can show me the model, I can tell you which bucket I would put it into, because I've never seen a risk and return model in finance that doesn't fall into one of these buckets. Yes? Well, there's a twist in these models, which is, if you think about the multi-factor models, if you think about how I fit the factors, I try different factors till I get the highest R squared, right? That's basically how I come up with. So almost by definition, if my job are explaining the last 30 years, multi-factor models are going to deliver higher R squareds than the CAPM. And just the same thing with proxy models. The way they came up with market cap and price to book is they tried 50 variables to see which. So any model where your objective is maximizing R squared and picking the factors, you're going to end up with a higher R squared explaining the past. To me, the test of a model is not whether it can explain the past, but whether I can forecast the future. And that's where these models break down, because we live in a market which is unstable, where the factors keep changing. And that's where these models kind of break down and don't do as good a job in forecasting. And that's why I don't think they've got they've been able to make the inroads in corporate finance and valuation that they have in portfolio management. Any other questions? Yes? There are 66 million people walking around thinking Elvis is still alive, right? With markets, I always take, it's hubris to ever think that we're going to build a model that's going to explain 80. I think a good model, I think I can take the CAPM and push the R squared up to 20% with better ways of estimating betas and risk premiums. And with 20%, that's about as good as I'm going to get. There's so much noise in markets on a day-to-day basis, you said, reasons which have nothing to do with fundamentals, that no model is ever going to get that kind of R squared. But it doesn't matter, because when you think about a 20% R squared, it sounds like a really low R squared, but it basically means when I estimate your cost of capital at 8%, the true cost of capital can be anywhere from 7.4 to 8.6%. And as a company, if you're that close to your cost of capital in investment after investment, you're probably pretty close to fair value. So when we come up with the cost of capital for a company, we have to think of it as a middle of a range. And that range is probably going to be plus or minus 0.5% for most companies. And that's the way I see low R squareds. It's not the end of the game. It just means I've got to be a little more cautious about how I view these numbers as absolute. They're not facts. They're estimates. And I have to be willing to change with the market around me. Okay? Yes?
Isn't CAPM also backward-looking?
If you get your betas from a regression, it absolutely is. The risk-free rate is not. And the way people use the CAPM, it is absolutely backward-looking. Because where do they get their betas? They go to Bloomberg, they run a regression last 2 years. Where do they get their equity risk premium? By looking at what stocks have done over the last 50 years. And that's what I'm going to fight head on. I'm going to say if I use the CAPM, I want forward-looking estimates. And we're going to talk about how to move away from the backward-looking approaches to the forward-looking approaches, because that's when you get the CAPM working much better. So when you get a chance, take your company, look at the perceived institution, and make this judgment for yourself, just like I did for my companies. Am I on safe ground assuming that the marginal investor is an institutional investor, diversified investor? Because the answer is no. Don't do anything rash right now. Don't change companies. Don't do crazy things. We'll come back and talk about what you might have to do to adjust the model to reflect the fact that you're more of a private business than a publicly traded company, as your company. And these models might not give you the right measure what the hurdle rate should be. So now let's talk about the inputs to the CAPM. So now it's going to be all the pragmatic question. How do I come up with the risk-free rate? How do I come up with the beta? How do I come up with an equity risk premium? I'm going to start with what should be the easiest of the three inputs to get. Because let's face it, when I want an expected return, I need a risk-free rate and I need a beta. And this number inside the brackets, I'm going to call an equity risk premium rather than think of it as RM minus RF, which is how we deal with it. It's the risk premium, the price of risk in the market. So of these inputs, the easiest one to get should be the risk-free rate, right? So let's start with that number because it's not as easy as it sounds anymore. I'm going to give you my definition of what goes into a risk-free rate, and I've given it to you before when I talked about the one-year T-bill and the one-year time horizon, but I'm going to repeat it. And then we're going to use that definition to see how we're going to come up with the risk-free rates. On a risk-free investment, you know exactly what you're going to make with certainty. That to me is the definition of a risk-free investment. That's why the one-year T-bill with a one-year time horizon was risk-free. I knew exactly what I was going to make, and I always made it. So if you look at that definition, two things fall out of it. The first is, if the entity issuing a security has any default risk, the rate you get out of that instrument cannot be risk-free. So you need an entity that has no, already I've raised the ante, right? Because there aren't that many entities in the world left which have no default risk. You're saying, what if there's a tiny bit of default risk? That's like being a tiny bit pregnant. Right? This is not one of those things, right? It doesn't work that way. This is, you either have default risk or you don't have default risk. It's just a little bit, no, it doesn't work. I have to clean up even those tiny bits of default risk. But there's another condition I'm going to add to this no default risk condition. There can be no reinvestment risk. In fact, let me give you a very simple example. Let's assume you want a 10-year risk-free rate, and you look up a one-year T-bill rate. A one-year T-bill rate is not risk-free if you have a 10-year time horizon, because at the end of the year you've got to reinvest and reinvest again and reinvest again at rates you don't know today. So let me ask you, so let me make that question. So if you have a 10-year cash flow, and the cash flow is in US dollars, you'd see why currency is going to matter in a second. What should I use as my risk-free rate? Can't use 1 year. Can I use a 10-year government bond? I'm getting closer, but even a 10-year government bond has a little bit of a problem. Every year, what do I get? I get a coupon which has to get reinvested at rates I don't know. The coupons are pain, right? Can I strip the coupons? If I strip the coupons from a 10-year T-bond, what do I end up with? It's a 10-year zero coupon government bond, and if I'm willing to make the assumption that the US Treasury is default-free, I now have a risk-free rate for a 10-year cash flow. I've opened a Pandora's box by doing this. Because that will mean my risk-free rate for a 9-year cash flow needs a 9-year zero, an 8-year cash flow needs an... So to actually do this right, I need a risk-free rate that actually changes depending on when the cash flow comes in. I don't want to do that. So I'm going to suggest an approximation that works for me. It draws on something banks used to do when they were banks. Remember the old banks, they used to make loans and then they used to get assets on the other side. Okay. One of the things they worried about was interest rate risk. And one of the ways they managed interest rate risk was by doing what was called duration matching. Duration matching, they take the duration of their assets and try to match it up to the duration of their liabilities, on average. They knew it was imperfect, because in a perfect world, you'd have to take a two-year liability, match it up against a 2-year asset. They said, you can't do that. We have hundreds and hundreds of assets and hundreds. So they take the weighted average duration of their assets and try to set it equal to the weighted average duration of their liabilities. You're saying, what's this got to do with corporate finance? Let's say I'm doing a 10-year project. I have cash flows in year 1, year 2, year 3, year 4, year 5, year 6, year 7, year 8. In a purest world, year 1 cash flows will have the year 1 zero coupon. Year 2 cash flows will have the year 2 zero coupon. Here's what I'm going to do instead. I'm going to take the duration of my cash flows. Duration is basically a weighted average when the cash flows come in. If it's a 10-year project with the cash flows back-ended, the duration of this project might be about 7.5 years. You see what I mean by back-ended? The big cash flows coming in 8, 9, and 10. I'm going to find one risk-free rate with a duration of roughly 7.5 years. The duration of a 10-year T-bond, for instance, is about 8 years. I'm going to use a 10-year T-bond rate as my risk-free rate for every one of the 10 cash flows, knowing that I'm using an approximation, but knowing also it's not going to make that much of a difference. I'll make life even simpler in corporate finance. Never ever use a T-bill rate, a short-term government rate. It shouldn't even enter the process as a risk-free rate because almost everything we do in corporate finance and valuation is long-term. You want a long-term default-free rate. In fact, the long-term I'm going to use is 10 rather than, you can go up to 30-year T-bonds, but I stay with the 10 because there are so many other inputs in corporate finance and valuation you have to make off the risk-free rate that if I use a 30-year rate, my life gets more difficult down the road. So I'm going to stick with a 10-year rate as my risk-free rate, and I'm going to move from currency to currency. So we'll start easy, and then we'll start building up to more difficult currencies. So here's my test. If I come to you with a currency and ask you a risk-free rate, I want a 10-year default-free rate in that currency. So let's start easy. Let's start with the US dollar. If I want a risk-free rate in US dollars today, I'm going to use the rate on a US Treasury, 10-year Treasury bond. And of course, I'm going to get down on my knees and pray that there's no default risk in the US Treasury because that's implicit. And that's going to be my risk-free rate. So right now, my risk-free rate in US dollars would be roughly 2.5%. That's a 10-year T-bond rate. In fact, in November of 2013, when I was doing this for Disney, and much of the numbers you're going to see are from that point in time, the 10-year T-bond rate, that was 2.75%. And from this page on, whenever you see a risk-free rate in November 2013, you're going to see the 2.75%. In the case of Deutsche Bank, I'm going to try to get a risk-free rate in euros because all my cash... The rule is very simple. It's not where your company is incorporated that determines what risk-free rate you should be using. It's what currency you've chosen to do your analysis in. In the case of Disney, I chose to do the analysis in US dollars because all the financials were in dollars. Why go looking for trouble? But in the case of Deutsche, I want a risk-free rate in euros. So what do I need to find? A nice government bond denominated in euros, right? And I did. In November of 2013, I found about a dozen bonds, all European government bonds, all denominated in euros. This is in 1997. We have drachma bonds and French franc. These are all euro bonds, all 10-year government bonds, and the rates are all different. Anybody here doing a Spanish company? No? Nobody? Let's say you're doing a Spanish company. You're going to do your analysis in euros because all their financials are in euros. It's November of 2013. You want a risk-free rate in euros. Which of these rates would you use as your risk-free rate? I'll tell you, if you're an investment bank, the answer is easy. Just use the Spanish government bond rate. But why can't you call it a risk-free rate? Because it's not risk-free. Why is it not risk-free? Because these are all euro bonds. The only reason for differences across those rates is why? Is because the market sees... I mean, if you're ever tempted to use the word government bond rate and risk-free as interchangeable, I have 3 words I'd like you to repeat 10 times every night for the next 10 nights, and you will never use the two interchangeably. Greek government bond. Just say that 10 times. You will never again say, government bond, it must be risk-free. It drives me crazy when people do it. It's not. The two are not equivalent. In some cases, you make the assumption it's default-free, and I am with the US Treasury, and I would with the Swiss government bond. I'm not going to be crazy enough to do it with the Spanish government bond or the Greek government bond. So I've kind of given away the answer. If I want a risk-free rate in euros for a Spanish company, which one am I going to use? The German, not because it's German, but because it is the lowest of the rates. In fact, you could argue maybe I should get the ECB rate, the European Central Bank. It's actually very close to the German bond rate, but you could actually argue that you want to go with the lowest rates. The reason I say don't get too attached to the German part of it, who knows? 10 years from now, the Portuguese 10-year bond might be the lowest. Miracles can happen. Okay? And you'd be using that. So if you have a currency choice and you want to find a risk-free rate, at least with the euros, you've got somebody who's viewed as default-free, Germany, and you're using their bond rate as your risk-free rate. You know what that rate looks like today? So 2.5% is the US dollar rate. What's the German 10-year euro bond rate look like right now? It's 0.3, 0.25. It used to be almost zero. It briefly flirted with a negative number, but it's about 0.3%. You think that's really low? Hold off on thoughts on what's higher. Don't play God right here. So that's low, that's high. We're not quite there yet, but that would be a risk-free rate if you're doing an analysis in euros today. Let's climb one step further up the ladder. In fact, with that process of government bond rates, if you can find an entity that's default free, you can use that rate as a risk-free rate. You say, how do I know whether something's default free? I'm going to cheat. I'm going to let somebody else do this for me. These are all governments which are AAA rated. Why is this cheating? Because I'm assuming the ratings agencies know what they're doing. Dangerous assumption, but at least it saves me some trouble. So these are all currencies where I was able to find a AAA rated entity where I could find the government bond rate, and I'm making the assumption that because they're AAA rated, they're default free, I'm using that. So I've got about 10 currencies here. So if you're doing your analysis in Australian dollars or Canadian dollars or Swedish krona, you're home free. You can look at the government bond rate, you got your risk-free rate. Just make sure you use the numbers from today. These are November 2013 numbers. If you open up the FT, usually in the government bond page, you can look it up, or you can look it up on Bloomberg. There are a dozen different places you can look it up, but you have risk-free rates in these currencies. Now comes the most difficult case. What if you're working in a currency where there is no default-free entity issuing bonds in that currency? This is going to be true for 75% of the currencies you work with, especially if it's an emerging market currency. So I'll take you through the process of what I do. This is very idiosyncratic. Most people don't agree with what I do. They feel that I'm overdoing it. And I'll tell you why I do it. Because I think if I don't do this, I'm going to end up double counting risk, and I'll back up that statement. So let's say I need a risk-free rate in Indian rupees. Why do I need it? Because one of my companies is Tata Motors. So I want to do my analysis in rupees, and I want a risk-free rate in rupees. I found a government bond rate denominated in rupees in November of 2013 of 8.82%. Sigh of relief that at least have a government bond rate in the local currency. A lot of currencies we won't even find that. We'll talk about what to do with those. But with the Indian rupee, I've got a government bond rate. I would love to use that as my risk-free rate, but if I do, I'm assuming the Indian government has no default risk, right? So I went to the Moody's website. And if you go to either S&P or Moody's and you look at sovereign ratings, which are ratings for governments, you'll see two ratings for every government. A foreign currency rating and a local currency rating. See, what's the difference? The foreign currency rating is the rating that Moody's attaches to India when it borrows in dollars or euros or whatever other currency. The local currency rating is the risk that Moody's sees in India when it issues rupee bonds. I prayed and hoped I'd see a AAA rating under the local currency rating. Because if I had, I'd have used the 8.82%. No such luck. The actual rating for India on the local currency was Baa3. Not a horrible rating, but it's not AAA. That Baa3 rating translates into a default spread of about 2.25%. You say, what do you mean translates into? I have a lookup table that I update at the start of every year, where if you tell me a sovereign rating, I'll tell you what the typical default spread is for that rating. It might look like magic, but what I use is actually a market called the sovereign CDS market, where I can look up what the market is attaching as a default spread. And since I have the ratings for about 60 countries and the sovereign CDS spreads for these countries, I essentially use that data to come up with a lookup table. Okay? If your country has a sovereign CDS spread, that's the other way you could do it. You could just use the sovereign CDS spread. We'll talk about why using the rating might give you a different number. But in this case, I'm using that 2.25% based on the rating as my default spread. It's an algebra problem. The Indian government bond rate is 8.82%, right? But it has some default risk in it. And if you buy into my way of assessing that default risk, 2.25% of that rate is because of default risk. I take it out of the 8.82%. I end up with a risk-free rate of 6.57% in Indian rupees. I'll tell you why. If I don't do this, I will end up double counting. If I leave the 8.82% as my risk-free rate, I can see what's coming. You'll get to the point where I ask you what your equity risk premium is for this company. And because it's an Indian company, you're going to attach this big equity risk premium. And we'll talk about how that equity risk premium is computed for most companies. And that same default spread would show up in two places. One pushing up your risk-free rate and one pushing up your risk premium. This is my way of keeping risk isolated where I think it should be in the equity risk premium. So that's my risk-free rate in Indian rupees. Using the same approach for renminbi, since the Chinese government's rating was much higher, the risk-free rate I got in renminbi was 3.5%, the government bond rate minus my default spread. So in rupees and renminbi, I now have risk-free rates. Then I looked at Vale. Now normally you're saying Brazilian company, you should be doing everything in Brazilian reais. But it's not just another Brazilian company, it's a commodity company. You're saying, so what? If you've ever seen the financial statements for commodity companies, they tend to report in US dollars. British Petroleum, for instance, reports in US dollars. It's become the default currency. So I thought about it for a second. I said, why am I punishing myself trying to get a Brazilian real risk-free rate when everything is already in US dollars? Currency is a choice. For Vale, what you're going to see me do is stick with US dollars as my currency. And that actually opens the door for some of you working with an Egyptian company or a Nigerian company. In fact, tomorrow's valuation, I think I'll put up a Nigerian company as a company for you to value. Rather than deal with Egyptian pounds and Nigerian naira, which are going to create headaches, you might decide to do everything in US dollars or euros, a different currency. But I have to be consistent. You're going to see me try to be consistent all the way through, because with Vale, I'm going to do everything in US dollars. Okay? In fact, there are some parts of the world, especially in Latin America, where people do things in real terms. You know what that means? Basically, they won't count inflation when they do their cash flows. And if you're not going to bring in inflation into your cash flows, your discount rate has to be a real discount rate as well. And your risk-free rate then has to be a real risk-free rate. So how am I going to get that? Put up TIPS, inflation-protected treasury bonds. Right now, the rate on a TIPS bond is about 0.6%. That's a real risk-free rate. So if you're doing everything in real terms, that is what you'd use as your risk-free rate. Now, just to close for today, when you think about the 2.25% default spread, there are three ways you can get the default spread for your country. One is, if your country has dollar-denominated bonds, this is true for a lot of Latin American countries, you can compare the rate you get on a dollar-denominated bond issued by that country versus the UST bond. This works only if they're both dollar-denominated. So November of 2013, for instance, the Brazil dollar-denominated bond at a rate of 4.25%. The T-bond rate that day was 2.75%. The default spread is 1.5%. So that's the first approach. The second is you can go to the sovereign CDS market, where rates get updated. In November of 2013, the spread for Brazil was 2.5% in that market. And the third is if you can give me a rating for your country, like you did for India, I can use the lookup table. You're saying, why are you giving me three approaches? Because in some countries like Brazil, you'll have all three. In most of Africa, you'll have probably one, just the rating. You're not going to even get a sovereign CDS spread or a dollar-denominated bond. So don't look a gift horse in the mouth. Don't complain about the fact that you have three different ways of estimating default spreads for Brazil. Just pick one, stay with it for the rest of your analysis. But the reason I have three is in many countries, you might have a choice of only one. So we'll end with that, and we'll end with one final question. I want you to think about this. And I'll start next class with this question. These are risk-free rates at the start of 2017 in different currencies. It's a gray part of this graph as your risk-free rates. You're saying, what's a purple? That's a default spread I've taken out of each to get to a risk-free rate. So the Nigerian Naira risk-free rate was about 8.2%. The Brazilian Real risk-free rate was, November of 2013. I want you to think about why risk-free rates are different in different currencies. Because if you can get the answer to that question, then you can deal with currencies. You cracked what I call the currency code. So Wednesday when we start, we'll start with that question of why do risk-free rates vary across currencies.
So I know that the two criteria that you said were one, it can't be a financial institution, and two, it can't be losing money. But I was wondering if we use Tesla. So even though they've been burning cash,
They're losing money.
their Q3, they reported positive revenue.
It's not good enough. You're going to end up with really. It's okay. You can do Tesla. You'll find yourself struggling in parts of the project. Just come in and talk to me.
Question about the beta conversation. So if you were to assume that all the assumptions are true, then only random movements move the stock price, right? Because everything's already priced in.
That's right. The stock price is moved to both random and macro variables. The only thing the CAPM says is that you get rewarded only for the macro. It says nothing about what causes the prices to move. Prices can move for random reasons, for specific reasons, macro reasons. But the portion of the movement that you're going to get rewarded for is only the macro portion.
So So then what if, let's say, for example, Amazon had really bad management, and so
But wait, did you suddenly find out bad management, or everybody agrees to that?
everyone agrees at a
And the
certain
price
point.
is already down.
Right, and then all of a sudden the management turns really good, so the price jumps up. Then if you measure the...
That's not market risk. So basically, you get rewarded for making that judgment because you made that judgment that the management was going to improve before the market did, right? And you're going to get rewarded. That's the essence of stock picking, right? That you're seeing, it's not picking good companies or bad companies. That'll make it so easy. It's picking companies where the market is misassessing what the company is in either direction. Or you look at a company like Google and say, you know what, markets are expecting great things from the company, but I think there's a fall coming. And you sell short on the stock. Or you take a company there where everybody, HP, where everybody, the management is horrible, but you say, I see change coming. So there will be firm-specific events you can get rewarded for where you will make money, but that's assuming that you are good at picking stock.
So then if you then measure the beta historically for a
It would
situation like
be
that,
close to zero. And here's the reason, right? Betas measure how you move with the market. So if you're up 80% in a month, let's say in that month the market was down 1%. In fact, that's why Valiant has a beta close to zero. Horrible things have been happening in stock, but horrible things happen every month. And if your stock keeps going down month after month after month, your beta will actually go down because you're going down whether the market goes up or down. And that's why betas and what the stock does don't always correlate. You can have great performing stocks with low betas and awful performing stocks with low betas and great performing stocks with high betas. And all. So any of those four combinations.
okay. All right. Thank you.
So is it as detailed as a regular?
I don't know if it's as detailed. I mean, it has financials.
You're going to be okay with that.
I think like European companies tend to have more.
No, private businesses often don't. This my Lego at one point in time was a public company, so
Okay, so
that might be the